Welcome to the deep dive. We're the folks who wade through all that info to pull out the really useful stuff. And today we're getting into something that sounds super powerful, right? Investing in heaps of companies with just one click. But, it can also feel a bit tangled up in jargon. If you've ever thought about getting into investing, especially here on the ASX, the Australian Securities Exchange, but felt a bit lost, yeah, this one's for you. Okay, so our mission today, we're pulling back the curtain on buying ETFs, exchange-traded funds on the ASX. We're going to break it all down step by step, cut through that confusing language, and give you, practical know-how. We're drawing this straight from a really solid guide for beginners. But quick heads up, super important. Our source material, this is all just for education. It's not financial advice, okay? It's about understanding, not telling you where to put your cash.
Yeah, and what's fascinating here is how ETFs really open up diversification for everyone. Someone wanting to get up to speed financially, they're just, well, incredibly efficient. You're not just buying one company share, bang. You've got a slice of a whole market, maybe globally, maybe just Aussie shares. But you really do need to understand the nuts and bolts, how to pick them, how to buy them. Otherwise, even a good investment can feel a bit like you're just guessing, you
Well,
know?
it lays the groundwork. So let's build on that. What is an ETF, really? In plain English, we hear the term all the time, but it can still be a bit fuzzy.
Okay, think of it like this. It's a digital basket of investments. Instead of you going out and buying, I don't know, 50 different shares one by one,
Which sounds exhausting, by the way.
right? You just buy one unit of this ETF, and that one unit gives you a tiny piece of everything in that basket. Could be shares, could be bonds, could be commodities. And usually these baskets are set up to track something specific, like maybe the top 300 Aussie companies
Hmm.
or a
Right.
bunch of global tech shares. The key bit is the name, Exchange Traded Fund. It's a fund, a collection of assets that you buy and sell on an exchange, like the ASX.
Just like buying a share in BHP or something.
Exactly like that. Simple buy-sell process. So yeah, it's diversification made pretty easy.
That basket idea really clicks. It sounds almost too straightforward. So, okay, someone's listening, they're keen. What are the first actual steps, the things you absolutely must have before you can even think about buying?
Right, before you pick your basket, you need a few things sorted. First up, a brokerage account. Now, if you want the units held directly in your name, which gives you that clear ownership record,
Mm-hmm.
you'll want what's called a Chess-sponsored broker. Chess is just the ASX's system for tracking who owns what. It gives you a HIN, a holder identification number. Think of it like your personal account number for your investments on the ASX.
Okay, so SUNYS means it's definitely mine.
Pretty much, yeah. Some brokers use a different model, custodial, where they hold the shares for you. Both work, but Chess is often preferred for that direct ownership feel. Then, standard procedure, you need ID. For the KYC checks, know your customer.
Like driver's license, passport.
Exactly. Just proving you are who you say you are. Standard anti-money laundering stuff. And obviously you need an Australian bank account linked up to deposit the money you'll invest. Finally, two crucial bits of info. The ETF's ticker code, its unique shortcut name on the ASX, and its PDS, the product disclosure statement.
A PDS, that sounds important, like the instruction manual.
Totally. And here's a really important tip from the guide. Your very first buy of any ETF on the ASX. It usually has to be $500 or more.
Ah,
It's called the minimum marketable parcel. Try to buy less than that first time, and your order will probably just get bounced.
good to know. That $500 minimum saves some early frustration, I bet. All right, so brokerage account set up, ID verified, cash ready, PDS in hand. How do you actually pick the right ETF basket? There must be thousands. Where does the PDS come in?
Absolutely. The PDS, or sometimes a shorter fact sheet, is your go-to. You don't need a law degree to read it, but you do need to check a few key things. First, what does it actually track? Is it Aussie shares? Global? Bonds? A specific sector like healthcare? Make sure it fits what you actually want to invest in.
Makes sense. Step one.
Second, fees. Look for the MER management expense ratio. It's an annual percentage fee. And look, even a tiny difference here, like 0.1% versus 0.5%. Over decades, that can seriously add up. We're talking potentially tens of thousands of dollars less in your pocket.
Wow, okay. So lower MER is generally better.
Generally, yes. It's like a small leak in your investment bucket. You want it as small as possible. It's not the only thing to look at, but it's a big one for long-term results. Third, buy-sell spread and liquidity. The spread is the gap between buying and selling prices. You want that gap to be small, tight. Liquidity just means how easily you can buy or sell without messing up the price. High liquidity, lots of trading, good sign. Means you can get in and out easily.
Right, you don't want to get stuck or pay way over the odds because no one's trading it.
Exactly. Fourth, currency. If it's an international ETF, is it hedged or unhedged? Hedged tries to cancel out the effect of the Aussie dollar going up or down against, say, the US dollar. Unhedged means your returns will be affected by currency movements. It's another layer of risk or maybe opportunity.
Something to be aware of, definitely.
Fifth, distributions. These are payouts like dividends. How often do they pay? Quarterly, half yearly. And crucially, is there a DRP distribution reinvestment plan? This lets you automatically buy more units with your payouts. Great for compounding your growth if that's your plan.
Like setting your investment to autopilot growth.
Kind of, yeah. And finally, sixth, risks. The PDS sells these out. You'll see market risk. That's just the fact markets go up and down. Normal stuff. Tracking difference. How well does the ETF actually follow its index? You want this to be small. And check if it uses complex things like derivatives. Maybe avoid those if you're just starting out.
Yeah.
Keep it simple, you know.
That's a brilliant checklist from the PDS.
Yeah.
Especially that point about fees snowballing. Okay, I've picked my ETF. I understand the risks and fees.
Got it.
When do I actually, hit the buy button? Does timing matter much?
It can, yeah, particularly for getting the best price smoothly. So the ASX trades from 10 a.m. to 4 p.m. Sydney time. There's a little period before the open and auction at the close, too. Now, the key thing, especially for global ETFs, say, one tracking U.S. shares, the buy-sell spread, that gap we talked about, it's usually tightest when the underlying market is actually open. So when New York is trading for a U.S. ETF.
Ah, because that's when the actual shares inside the ETF are being actively priced and traded.
Exactly. There's more real-time info, more liquidity for the market makers setting the ETF price here. And a common mistake the guide highlights, trying to trade right at the 10 a.m. open or in the last few minutes before 4 p.m.
Why is that bad?
Well, spreads can sometimes widen out then. There can be a rush of orders, a bit more volatility. It's often smoother to wait maybe 15, 20 minutes after the open, let things settle down a bit, unless the spread looks fine, of course.
Okay. Avoid the mad rush at the start and end if possible. Good tip. So we've timed it right, avoided the rush. What does actually placing the order look like on my broker screen? The guide had 6 steps.
Yeah, it's pretty logical. Think about a typical online broker platform. They're all fairly similar in flow. 1, deposit cash. Got to have money in your linked cash account first.
Yeah.
Obvious, but...
Step 0, really.
True. 2, search the code. Type in that ticker, like VAS or whatever you chose. That brings up the quote page for the ETF. 3, quick price check. Look at the last price it traded at. See if there's an INAV or NAV shown that's the indicative net asset value, a real-time estimate of its worth. And definitely check that buy-sell spread again. Does it look tight? Reasonable.
Just a quick sanity check before you commit.
Exactly. 4, pick your order type. This is important. You've usually got 2 main choices, limit order or market order. For beginners, the guide strongly recommends a limit order. You set the maximum price you're willing to pay per unit.
So it protects you from paying more if the price suddenly jumps?
Precisely. It's a safety net. A market order just buys immediately at the best currently available price. It's faster, but if the spread widens just as you click, or if it's thinly traded, you might pay more than you expected.
Stick with limit orders, especially starting out. Got it.
5, enter the quantity. How many units do you want? And remember that $500 minimum for the first buy. So if the ETF is, say, $95 a unit, you need to buy at least 6 units to clear $500. So 6 units times $95 equals $570. Or, maybe you want 10 units for $950 total. Just do the math.
Okay. Quantity sorted.
6, review and place. The system will show you a summary. ETF name, price limit, number of units, estimated total cost, and the brokerage fee. Double check everything. Looks good, hit submit.
And then hope it fills.
Well, yeah, if it's a limit order, it might not fill instantly. If your price isn't being met, you can usually just leave it in the system for a while.
Yeah.
Or if you want it done, you could potentially cancel the order and place a new one with a slightly higher limit, maybe just a cent or 2 more to kind of meet the market.
That makes the actual doing part seem much less scary. It's just following the steps. So, okay, order placed, it's filled. Success. What actually happens next? Paperwork. When do I really own it?
Right, post-purchase. First, you'll get a contract note emailed from your broker, usually pretty quickly. That's your official receipt, confirming the trade details.
Keep that safe, I assume.
Definitely. Then comes settlement. This happens T+2, meaning 2 business days after the trade day. That's when the money officially leaves your linked bank account and the ETF units are formally registered. If you use a Shaz broker, they're registered under your HIN. You now legally own them.
T+2. Okay. What about income and taxes down the track?
Yeah, good question. Many ETFs pay out distributions that income they earn from the underlying shares or bonds. Could be quarterly, could be semi-annually. And for tax time, after June 30 each year, the ETF registry will send you an AMIT or AMMA tax statement.
That sounds complicated.
Actually, it makes things easier. It breaks down all the income components, dividends, capital gains, foreign income, whatever, into the specific categories the ATO needs. So your accountant know exactly what goes where on your tax return. It's super helpful.
Oh, right. A cheat sheet for tax time. Nice. And that DRP thing.
Yeah, the distribution reinvestment plan. It's usually optional. If you tick that box, instead of sending you the cash distribution, they use it to automatically buy more units of the same ETF for you.
So you just keep accumulating more without lifting a finger.
Pretty much. It's a great way to compound your investment over the long term, if that fits your strategy.
Okay, that covers the after-purchase stuff really well. The AMIT statement sounds like a lifesaver. Now, learning from mistakes. What are the common tripwires people hit when they first start buying ETFs? The guide mentioned a few.
Yeah, definitely some classic mistakes to try and sidestep. We touched on buying right at the open or close. Spreads can be wider than potentially costing you a bit extra. Just be patient if you can.
Right, the volatility trap.
Using market orders on thinly traded ETFs. Big one. If there aren't many buyers or sellers, a market order could execute at a really bad price. Limit orders are your friend here.
Safety first.
Ignoring the fees and the PDS. Seriously, read the key parts. Understand what you're paying and what the ETF actually does. That MER compounds, remember.
Don't skip the homework.
Forgetting the $500 minimum for that initial purchase on the ASX. Simple, but catches people out.
Yep, heard that one loud and clear.
Panicking during normal market dips. ETFs track markets, and markets go up and down. Seeing your investment drop 5% is normal. Selling in a panic often locks in losses. Investing is usually a long game.
Gotta have the stomach for the swings.
And lastly, related to timing. Buying an ETF that tracks, say, U.S. shares when the U.S. market is closed. Spreads here on the ASX can widen out significantly then because the market makers have less certainty about the underlying prices. Try to trade when the relevant overseas market is open, if possible.
Great list of things to watch out for, especially the market order on thin ETFs. Easy mistake to make. Okay, let's do some quick fire questions that often pop up. First, W8BEN forms. Do I need one for my ASX ETFs?
Generally, no. Most ETFs listed on the ASX are Australian domiciled. The W8BEN is mainly if you're buying U.S. domiciled investments directly on a U.S. exchange. So for standard ASX ETFs, you're usually fine without it.
Phew, less paperwork. Okay, Chess and Win, just nail those down one more time.
Sure. Chase is the ASX's electronic system for settling trades and tracking who owns what. A Chess-sponsored broker gives you a ANON holder identification number, which means the ETF units are registered directly in your name on the CS sub-register. Gives you that direct legal title.
Clear ownership. Got it. Taxes scary or manageable?
Manageable. Keep that annual Amitama statement safe. It arrives after June 30th and tells you exactly what income components you receive for your tax return. And remember, the DRP might have tax implications too, but often simplifies things as you reinvest rather than taking cash. Talk to a tax pro if unsure, obviously.
Right. The statement is key. Last one. How much cash do I really need to start?
That first trade, as we said, needs to be $500 or more on the ASX. That's the minimum marketable parcel rule. After you own some units, you can sometimes buy smaller amounts depending on your broker. But yeah, $500 is the key number to get started with any single ETF holding.
Okay, wow. We have genuinely covered a lot of ground here. From figuring out what an ETF even is, to the nuts and bolts of buying one, what happens after, and the pitfalls to avoid. It feels like we've really unpacked this. So wrapping this up, what does this all mean for you, our listener, thinking about your own investment journey?
Look, this deep dive really shows that getting into ETFs on the ASX isn't some dark art, right? It's accessible. It puts powerful diversification within reach. You've moved from maybe just hearing about ETFs to understanding the how they work, how to choose one, how to actually buy it, and hopefully how to do it with a bit more confidence. You're equipped now to approach this not with fear, but with a clearer plan. So maybe the final thought is this. Considering everything we've walked through, the options, the steps, the potential hurdles, what's the one aspect of ETF investing you feel you need to dig into next? What will deepen your understanding and make sure it really lines up with where you want to go financially? Maybe it's comparing specific types of ETFs. Maybe it's looking closer at the tax side for your situation. That next step in your own research, that's where the real empowerment happens.